Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. PacWest seeks to calm sentiment after its stock drops 60% after hours. The lender confirms it's in talks with several potential buyers or investors will bring you pre-market moves. U.S. futures point higher after the Fed hikes by 25 basis points and signals a pause in its tightening cycle. The ECB is up next, with markets seeing a downshift to a 25 basis point hike on signs that inflation may be topping out. So good morning, everyone. Also, May the 4th. I know for a lot of the Star Wars fans out there, May the 4th be with you, but never mind. We have to get to data. Euro area April services PMI coming in pretty much in line with expectations, maybe a touch below expectations because we got 56.2. Remember, anything above 50 means we're in expansion territory. And actually what we were expecting, the preliminary figure, was a 56.6. Now, the focus firmly on the ECB after we had Jay Powell yesterday. If you look at European stocks, a lot of concern about earnings out there. Now, be prepared for a rate decision from the ECB to maybe move some of the expectations. Certainly on some of the currency, the dollar for the moment extending a decline. And then you look at Shell, one of the biggest gainers in today's trading session after it maintained the pace of share buybacks. It also reported another strong quarterly profit despite lower oil and gas prices. But then the earnings picture for a lot of other sectors, maybe not as well. Some of the other things we're looking out for is not only the price of oil, but of course the regional lender PacWest and some of the anxiousness we're seeing in U.S. regional banks in the U.S. Does that spillover impact Europe and impact the ECB's thinking? The picture overall for a lot of these indices in Europe, it's still down. Again, it could move fairly quickly, but look, the rate debate resumes with policymakers, deposit rate being seen gaining a quarter point to 3.25%, which would really mark a slowdown in the hiking cycle from the ECB. This is a picture for the banks. PacWest, the one story that we are really following very closely for the twists and turns. We have our reporters on the ground who've been speaking to people familiar with the story, saying they're now looking at all options, including a possible sale pre-market. Another huge sell-off for PacWest, down 44%. So the Federal Reserve has hiked rates by 25 basis points, hinting that it may be the last move of the tightening cycle. Meanwhile, these PacWest shares pre-market plunging following this Bloomberg report that the U.S. regional bank was said to be weighing options, including a sale. Overnight, just to reiterate everything we know, we learned that PacWest has been approached by several potential partners and investors. Despite the banking turmoil, Fed Chair Jay Powell was more optimistic.
Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode and will work to prevent events like these from happening again.
Well, we're now joined by Catherine Neese, Chief European Economist at PGIM Fixed Income. Catherine, thank you so much for coming on. I thought Jay Powell yesterday was fascinating because he had this really tough job of dealing with the banks, pushing back against market expectations, with a cut later this year. How do you think he did?
I think he did a good job. It's a difficult job. The central banks, including the U.S. Federal Reserve, very much trying to balance between not wanting to be seen stepping back from achieving their inflation mandate, but at the same time not appearing tone deaf to what is going on in the banking sector and these fragilities. Clearly that's going to be adding to the tightening and credit conditions in the U.S., and they really just don't want to overdo it.
But so is the market pricing in things correctly, or are we going to see a Fed pivot?
So my concern up until now has been that perhaps the market's been a little bit too sanguine about some of these tail risks. It might not be a base case, but there's a good plausible chance that we could see some of these tail risks crystallizing, things like a more serious recession, a downturn in the U.S. We could also, of course, see more negative supply shocks at the global level hitting Europe that have spillover impacts on the U.S. So a bit of that complacency does worry me to a degree.
And so what I found fascinating is that so far the Fed also tried to say, look, we're dealing with inflation, but didn't really want to do anything with interest rates to deal with the possible credit crunch and the banks. I don't know whether that's a fair analysis and whether yesterday was a turning point in that fight.
Well, using interest rates is to deal with a what is potentially a financial stability risk is a very blunt instrument. And there are other instruments at the disposal of the central banking authority in the US and at other central banks. And those will be better suited to addressing those pockets of risk where they see them. But that's not to say that monetary policy is going to completely disregard these financial stability risks. I think after the global financial crisis, you saw a number of central banks embed into their flexible inflation targeting strategies a recognition that monetary policy does need to be alive to these financial stability risks. And for me, what that means is a shallower rate path, and perhaps the destination is lower than it would otherwise be. And I think we saw hints of that in the Fed meeting yesterday.
Thank you so much, Catherine Neese, PGIM, Chief European Economist. Of course, she stays with us, and we'll have plenty more on everything to do with the European Central Bank and, of course, what comes next in terms of Bunds and BTPs. The European Central Bank set to publish its latest rate decision today comes after data showed core inflation cooling in the euro area in April, while credit conditions tightened after the banking sector turmoil. For more, Bloomberg's Maria Tadeo is outside the ECB in Frankfurt. Maria, good morning again. So we are expecting a hike. The real question is by how much and what other tools do they have at their disposal?
Yes, Francine, and you have the ECB watch, by the way, the Coronation watch, the Fed watch. You have something for everyone in this show. But in terms of specifically here in Frankfurt, by now it's pretty much understood. The European Central Bank, as you say, will hike. Again, how can they not when you see headline inflation, which is their target, to hit that close but below 2%, still moving around the 7%. And then that takes us to the question of how much, what is the magnitude, though, of this hike to come today? And Francine, I think we've talked about this the entire morning. There is this idea that they call that carries momentum is at 25 basis points because of all of the data that we had over the past week. You had that lending survey, which obviously the market was paying very close attention to because of the jitters in the banking sector, which continue, by the way, in the mid-tiers when it comes to the U.S. And then, of course, that core headline, core inflation that came in at 5.6%. Remember, the ECB said that may not be the target, but is a number they closely watch to see whether transmission is working. That cooled down in April. In many ways, if you put all of this together, that would back the case for 25 basis points. There are some calls, I'm looking at Credit Agricole, which say we stick with the 50 basis points. This is still inflation way too high, an economy that is still pulling along. There is a case to go aggressively, but going into the meeting, it's the 25 basis points that takes it. From a market perspective, obviously nothing official until Madame Lagarde makes it official.
So, Maria, when you look at some of the other things that we're watching out for, I mean, does the balance sheet naturally, continue on the path that we've seen so far, or could we see more news on that?
Yes, and that's an excellent point, Francine, because one of the trends that we've seen is that when you look at a rate decision like this and just that move, it is a twofold package when you look at QT. The idea is that when you go softer in rates, that imply or would mean that you have to go faster or imply an acceleration on QT. That is a way in which you get to a majority or a large consensus around decisions like this. You have to give something to everyone. It's a constant give and take when it comes to 20 central banks that have to set monetary policy together. The other issue beyond the QT and the rates, which, as I say, in many ways are combined as one, is whether or not Madame Lagarde will again comment on the banking situation. That is not over by any means overnight, that news flow from the US, and whether she'll reiterate what has been the guidance until now, that given the uncertainty, this is a central bank that will focus meeting by meeting, look at the data, still monitor core inflation, but also the transmission of this monetary policy.
Thank you so much, Maria Tadeo. They're outside the ECB in Frankfurt. Now, a little bit later, we bring you live coverage of the ECB's rate decision, as well as Christine Lagarde's press conference. That's from 1:15 UK time. Now, still with us, Catherine Neese, Chief European Economist at PGIM Fixed Income. Catherine, so many questions actually about how Christine Lagarde navigates it, especially on the back of what we heard from Jay Powell. What's the right tone she needs to adopt?
Yeah, tricky one. She did a great job at the last meeting as well. So I think there will be a lot of focus. And there are some similarities, but also really important differences. If we look, for example, at core inflation, US, Euro area, it's much more clearly been on a declining trend in the US, whereas in the euro area, it's still been on an upward march. So that does put, I think, the ECB into a different space. In terms of today's meeting, I would have thought that they would want this to be a no surprises meeting, to deliver on the expectations that Maria, just set out of a 25 basis point rate rise, to say something about perhaps accelerating the pace of balance sheet runoff. And frankly, I do expect them to continue with a more hawkish tone than what we heard from the Fed chair, simply reflecting that differential inflation picture in the euro area. But nevertheless, a step down from 50 to 25 is notable.
So, and does it mean that actually they worry less about inflation or that they worry about a recession? I mean, this is, if we look at, possible recession in the euro area, this will be central bank made. So could we see a recession that's actually much more shallow than previous ones?
Well, I think, if anything, we have been surprised by the resilience in the euro area coming through this winter. You mentioned some of the data that's just come out on the PMIs. I and many others were expecting that we were going to see a really significant recession through the winter as the region was, in short order having to wean itself off of Russian gas. And instead, we've seen, a much more resilient picture. The latest data are saying the recession has been averted. But nevertheless, I do think the ECB, like the Fed, are going to be worried about overdoing it. They've done a lot of interest rate rises over an exceptionally short period of time. The balance sheet contraction is pushing in the same direction of tightening credit conditions. And of course, now the US banking sector fragilities, even if you don't have any contagion risk in Europe, that will be adding to globally tighter credit conditions that the ECB needs to be mindful of.
Catherine, thank you so much for all of your insight. Catherine Neese there, Chief European Economist at PGIM Fixed Income. Now, coming up a little bit later today, we'll be speaking to the former ECB Chief Economist, Peter Prett. That's just after 4 p.m. London time, 11 a.m. in New York. Stay tuned for that. Now, let's also look at some of the pre-market for some of the banks. This is the story, of course, that we'll keep a focus on. This is after a Bloomberg scoop yesterday is saying that, well, certainly PacWest Bancorp is looking at all options, including a possible sale to investors. Now, yesterday, actually after hours, that share price was down 60%. Pre-market, it's down now 40%. But if you put that in context, over the last week, it was down 10% on Monday, it was down 30% on Tuesday. So it's been cried around for this bank. We'll have much more on what that means going forward. Also, we look at the Aperol maker Campari defying consumer gloom with the sales beat. We discuss the demand for tequila, for bourbon, and aperitifs with the chief executive, Bob Kunze-Concewitz. That's coming up next. It's an exclusive conversation, and this is Bloomberg. Let's get straight to the Bloomberg First Word News. Here's Alex Morgan. Hi, Alex.
Hi, Frank. Good morning. Vladimir Zelensky has denied that Ukraine was behind a drone attack on Vladimir Putin's residence in the Kremlin. Speaking while he was visiting Helsinki, Zelensky says Ukraine only fights in its own territory, saying Moscow may be trying to distract from its battlefield failures. Well, unverified video from social media shows what Russia calls an attempt on the life of the president and a planned terrorist act. Bloomberg has learned that President Biden has selected the Federal Reserve Governor, Philip Jefferson, for a promotion to vice chair. Biden will also nominate World Bank economist Adriana Kugler to an open board slot, becoming the central bank's first ever Latina policymaker. Well, both nominees fill roles left vacant by Lael Brainard in February. A 13-year-old student has been arrested after opening fire in their school in central Belgrade yesterday. Serbian police say 8 children and 1 guard are reported to have been killed and 7 others injured. That's Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Francine.
Thank you so much. Now, coming up, we speak to the Campari Group Chief Executive Officer, Bob Kunze-Concewitz, off the back of their recent first quarter sales beat. So we'll come back to that. We'll talk about drink trends. We'll also talk about the U.S. market. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, consumer demand for aperitifs, tequila and bourbon have helped Campari Group to a first sales beat. Now, the Italian beverage maker reported organic growth in the U.S., its largest market, boosted by a double-digit rise in Wild Turkey bourbon sales. Aperol, meanwhile, saw triple-digit sales growth. People are drinking too much. Off the back of their recent, better-than-expected first-quarter sales and earnings, we're joined by the Chief Executive Officer. He's Bob Kunze-Concewitz. Bob, thank you, as always, for coming on Bloomberg to talk to us about trends and some of the things that you're seeing out there. It's pretty incredible when you look at what you've been reporting and of what you've been doing for Campari. You know, compared to your peers, you're seeing strong demand in the U.S. What's the difference between you and some of the rivals, and can that strong growth in the U.S. continue?
Well, first of all, our portfolio is skewed towards the hot categories. So Kentucky bourbon, tequila, 100% agave tequila, and the aperitifs, which we obviously own, are really the hot categories right now. And within those categories, we have very, very strongly brands with great equity and momentum. And what you're seeing in the U.S. right now is a tale of places of consumption as well as target groups. Now, if you look at it, revenge conviviality is alive and doing well, but to a large extent, consumers have plateaued what they're having at home, or it's slightly down, and they're actually going out. And we've been traditionally always very strong in the on-premise in the U.S. market. Also, we target young urban professionals, which are not impacted by the current, let's say, macroeconomic challenges, whereas some of our peers, particularly those who are skewed towards cognac, they are being challenged because although cognac is a very premium category, the typical cognac consumer is blue collar, and that consumer is being challenged right now.
So, Bob, and I love the word actually, revenge conviviality. This is, because people were pent up home, that they want to go out or host people, and maybe they buy more drinks. But does that mean that you can also, if you're trying to premiumize, does it mean that almost the sky's the limit in how much you can charge, or do you have to be much more careful in how much you put your prices up by?
Well, I think, pricing has increased because the industry has faced significant increases in input costs last year, particularly glass and alcohol, which are highly correlated to energy costs. So we've put through price increases. I think some categories probably exaggerated, namely the one I nominated earlier on, and they're bearing the consequences of it. Obviously, those brands which are more skewed to the on-premise are able to pass more pricing because there's less pricing elasticity there.
Bob, and you're wearing a beautiful Campari red tie, because I know you're also premiumizing some of the bottles, for example, for Aperol. But at what point does that translate into lower volumes? I don't know whether there's a model that you look at, or again, are consumer behaviors just changing because of what we lived through in the pandemic and how long that lasts for?
Look, it's a question of the value perception and the value equation in the consumer's mind. Last year in Europe, we've increased Campari prices between 15 and 25%. It was more of a price repositioning of the brand because the brand's image was there and the retail prices were here. So we had to get them up and close that gap. And frankly, we haven't lost any volume. A consumer recognizes quality and they're ready to pay for great brands.
We follow your acquisition trail quite closely. Last year, you bought a U.S. whiskey maker called Wilderness Trail. Is there any part of the market where you're targeting acquisitions as well, whether it's local or something like a bigger brand worldwide?
Last year, we actually did 5 acquisitions. We bought the French aperitif brand Picon. We've bought also the super premium Vermouth del Professore, as well as Wilderness Trail. And we're constantly looking at new opportunities. We're focusing on those categories where we are and looking for more premium brands and brands with an on-premise focus. If you can add to that from a geographical standpoint, a nice footprint in the US as well as in Asia, bingo, that would be the best for us.
So what looks exciting right now, Bob, every time I go anywhere, I get offered either, a lower alcohol kind of cocktail or even a no alcohol cocktail. Is that where the world is heading?
The world right now, the consumer is heading in 2 directions. One is the high ABV classic cocktails. For example, the Negroni, which we own, is the #1 cocktail in premium bars, or the old-fashioned. And at the same time, they're going towards lighter cocktails with lower ABV, more refreshing type with bubbles. And that's where the likes of Aperol come in with Aperol Spritz or Campari with Campari Spritz. And in the non-alc side, we're actually doing very, very well with the non-alcoholic Italian aperitif Crodino, which is growing very strongly in international markets.
But we need to do a show where we talk about cocktails and how to make them. But very quickly, do you worry about the supply chain? So do you have to be more local as the world is fragmenting?
Well, you know, in the world of spirits, origin is very, very important. You know, to be called a Scotch, you need to be distilled in Scotland, to be called a Kentucky bourbon in Kentucky. And we also insist on having our aperitifs being produced in Italy. So I'm afraid, you know, that's going to stay for a long time. Potentially, you know, down the road, we could, you know, send out concentrates and bottle them in other markets. But at the moment in time, we're really insisting on the authenticity of the origin.
Thank you. Bob, as always, thank you so much. The Campari Chief Executive, Bob Kunze-Concewitz. This is Bloomberg. Good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacqua here in London. Now, on today's show, we look ahead to the coronation of King Charles and dig deeper into the monarch's finances. Now, in a moment, we'll speak to the chief executive who manages the largest of the royal investment entities, the Crown Estate. On last count, the firm manages £16.5 billion worth of assets with a net revenue profit of over £312 million. Now, since the death of Queen Elizabeth last September, the Crown Estate has a new owner, her son, King Charles. However, the estate, as it declares, is not the private property of the king. The royal family is funded via the sovereign grant, an annual lump sum derived from a 1760 agreement between the monarch and the UK government. Meanwhile, the Crown Estate also profits and revenue are deemed public money, which it pays to the Treasury. Now, over £15 billion of his assets line the property sector, notably the whole of Regent Street and St James's Street in London. It also boasts 2.6 million square feet of redesigned office space in the nation's capital. Now, the Crown Estate also focuses heavily on renewable energy. It holds the right, for example, to virtually all the seabed surrounding the UK out to about 12 nautical miles. Well, the Crown Estate says UK offshore wind farms have produced 45 terawatt hours of electricity last year, making the UK the world's second biggest offshore wind generator. Now, on Saturday morning, the King Charles III will leave Buckingham Palace in a 6-horse-drawn carriage en route to Westminster Abbey. The route will pass key properties associated with the royal family that has an overall market value of more than £2.3 billion. Alex Morgan reports.
So go on then, how much do you think Buckingham Palace is worth? More than £1 billion. And that's just the start of the unique collection of assets that underpins the British monarchy.
The route King Charles will take to his coronation is just over a mile long, but that mile gives a snapshot of the monarchy's billions. As the King's coach heads down the Mall, on his left he'll be able to see these cream-coloured mansions.
Now that's Carlton House Terrace. They've got marble staircases, ballrooms and a view over St James's Park, which is literally there. Now that makes them some of the most desirable homes in the city, and many of those super prime buildings are the property of the monarchy through the Crown Estate.
As the King makes his way through Trafalgar Square, if he were to crane his neck up the Strand, he could probably see the Art Deco offices next to the 5-star Savoy Hotel.
Now those also support his royal fortune through the Duchy of Lancaster.
The Crown Estate and the Duchy of Lancaster are the two main entities that fund the British monarch. These estates oversee total assets of about £17 billion.
But here's the quirk. The King doesn't actually own any of these assets, not in the way you and I might use the term. Here's why.
Think about the Pope and the Vatican. The Pope does not own that personally. In the same way, King Charles does not personally own Buckingham Palace. He cannot put it on the market. These assets are held in trust effectively for the UK monarch and his successors over generations.
So while the crown jewels can't go up for sale, there are some serious perks to being king. For one, the monarch pays no inheritance tax on anything received from their predecessor. That's helped to preserve the Windsors' personal family fortune.
He is, through the personal assets that he has, through Balmoral and Sandringham Estate and the land holdings, significant land holdings around them, he is a very wealthy man. We estimate at least $800 million for his personal wealth.
So given that sizable nest egg, when King Charles comes back to Buckingham Palace after the coronation, it'll probably feel quite irrelevant whether he actually owns it or not.
That was Alex Morgan breaking down the coronation procession route of King Charles and the wealth attached to it. Now here with me, Bloomberg's Ben Staples. Ben, thank you for joining us. I mean, you're looking at the wealth of the king and exactly what we can expect going forward. So what can we see along King Charles's procession route?
I think, as we saw in that report just there, Francine, Carlton House Terrace really is one of the ultra-prime residences, properties in the world. So actually, in the past, the Crown Estate has sold some of them in the past to billionaire families, including the Hindujas from India. They've refurbished it, spent more than 100 million in total to acquire and refurbish that. So we see Carlton House Terrace. We also see part of some of the crown jewels in the royal property portfolio. They're not part of the Crown Estate, but of course we'll see Buckingham Palace, but also St James's Place, and also maybe Clarence House. We might catch a spot of that. And right just before he turns to Whitehall, as we heard in that report, he might see some of the assets held on the Strand. And that's an important part of the private sort of piggy bank for the king, part of the Duchy of Lancaster estate. Just on the Strand, there are quite a lot of assets down there too. So all around where he's going to be walking on Saturday, the king is going to be surrounded by his riches.
Thank you so much, Ben Staples, our Bloomberg's wealth reporter. I mean, it is quite an amazing and in times controversial procession that we could see. Now, joining us now is Dan Labad, Chief Executive of the Crown Estate. Dan, we're really excited to have you on because not many people know what the Crown Estate do. So we laid it out in terms of, you know, where the money goes. Do you have to manage this differently to basically a private company if it were on the FTSE?
Yeah, well, first of all, it's important to say that we're very unique.
Yes, you are.
But you know, we are set up independently under an Act of Parliament, the 1961 Crown Estate Act, and our role is very simple. You know, we have to create value for the country, for the taxpayer. We do that in a number of ways. One is obviously delivering 100% of our revenue to the Treasury. And in addition, thinking about some of the long-term national needs, for example, how we tackle climate change and energy security, how we think about the environment generally in the natural world, and thirdly, how we think about economic growth, something that, you know, is really, really important at the moment with families suffering and, you know, what's going on in the country.
And we know that, of course, the king has always, from a very young age, taken a very keen interest and cares deeply about sustainability. Is that why it's one of your mandates, or this was just in bed because of your closeness to basically Treasury and, you know, the fact that you need to make money but also maybe want to do some good?
Yeah, we act and operate independently. We have to under our remit, under the Act. So the royal household has no day-to-day involvement with the business. And the things that we're talking about are things that are obviously, you know, in the national interest. Now, clearly, being involved in things like climate change and the environment is something that, you know, the royal household is very interested in and supportive of what we do as a result. But we are independent and we operate day-to-day under our own remit.
So you own a lot of the central London property. What's the outlook for that market like?
Well, it's important, I guess, for your viewers to understand a little bit more than central London. And I'll come back to that, but we also have a large land holding across the country in terms of opportunity for economic growth that we utilise. Where a large...
This is what, regeneration?
Regeneration, looking at another area that I'll get to in a moment with the seabed and how we make sure that, you know, the benefits of the seabed come back on shore. We're one of the largest rural landowners in the country. In fact, one of the largest food producers. So the relationship.
You're everywhere.
Yeah, I guess this is the point. And marine is obviously the last, and obviously offshore renewables is a huge part of our future and a huge UK success story that we haven't been the only party to, but we are fundamental in making that the success it needs to be. I think, you know, coming back, you know, what's important is that 100 years ago, our remit was to create value for the country. And we used our land holding back then in a very different way to the way we're using it today, because things like climate change and the environment weren't as prevalent. And in 100 years from now, who knows what the challenges are going to be. And that's the exciting thing about the Crown Estate. It's a company for the country. And my role as chief executive and our team's role is to ensure that we're setting it up for the future so we can continue to do that.
So if we break down, we'll get to the seabed in a second, we'll maybe talk about regeneration, but central London property is one of the hot topics that we try and figure out whether it goes up or down, whether you see challenges and what your tenants are telling you.
Yeah, so clearly coming off the back of COVID and the digital disruption we started to see before COVID, property is full of challenge, interest rates and a whole host of other factors. One of the good things that we're seeing post-COVID is footfall returning to pre-COVID levels. We've put a lot of effort into, because we're contiguous owners, as in we own a single large piece of real estate, we can think about the spaces between the buildings, not just the buildings themselves. And that goes a long way to ensure that we're getting people onto the streets, which was one of our concerns during COVID. Are we going to be able to make that happen again? Well, that is happening. And now talking to our customers, residential, commercial and retail, and looking at how they're changing.
So does that mean that you're changing with them?
Yes.
Actually, so the trend is what, working more from home? Does it change forever the way that we use and shop in central London?
Well, I think anyone sort of giving an absolute prediction on where that'll end up, I'd love to have that crystal ball. But I think what we do know, it's changing. I think, and we think that London is long-term going to be very prosperous and continue to be. But as you say, I think the dynamics will change, how we activate the streets. And we're seeing that from our customers now. Different type of retailers, for example, are interested in Regent Street than were 5 years ago. Offices are still prime office space is still incredibly attractive. The challenge at the moment is, can we produce enough of it? And can we produce enough of it in a way that customers want, decarbonised and things that are, of the day?
And I mean, one of the things that, a lot of business leaders certainly stood up and listened to was the Burberry chairman last week telling Rishi Sunak, look, the retailing environment in the UK is very difficult because of the VAT and the fact that they're not giving foreigners a chance to come in. Is things like that things that you think about and lobby the government for because it makes a difference, or do you stay away from this?
We focus on what will work for our customers. Right. That's our focus. Yeah. And because the challenge at the moment is everyone trying to work out what good looks like, our focus is keeping up what good looks like for our customers.
Talk to me a little bit about the seabed. And this is, in our research, it's amazing. We had a map saying how much you own in the 15 nautical miles. How will that change as I guess, the energy transition accelerates?
Yeah, so I think the seabed, first of all, is a huge UK success story, as I was saying. 25 years, second only to China in terms of market size, one of the most attractive places to invest in the world. Future jobs, which is incredibly important, and it's changing for a number of ways. It's becoming busier generally. There's navigation, there's defence, there's fishing, there's the environment, to name just a few. And on top of that now, the importance of the rollout of renewables. And one of the things that's incredibly important is that we're not going to achieve our net zero targets as a country if we don't utilise the seabed. But we have to do it in a way we're embracing different technologies. Wind's one technology that is up and running at the moment, but we have to think about carbon capture and storage. We have to think about hydrogen. And we have to think about, in that context, how we protect the seabed from a natural perspective. Incredibly important.
I mean, you're really at the forefront of every question that we ask all of our chief executives. Do you worry about AI? Do you worry about retraining? Like, if you're going to create jobs in these new technologies, whose job is it to make sure that you find the right staff with the right qualifications? Yeah,
so I think we are concerned about skills levels in the future. And one of the things that we've done recently in the area of heritage and decarbonising is working with partners in London, other businesses and government, on how we think about bringing those skills in. So coming back to your question about, who's responsible, I think it's all our responsibility. It won't just happen. We have to all work towards. But I think, first of all, our role is to make sure we're creating the demand so that we have the pull factor, which I think offshore renewables is a key part of. And then as part of that, we have to ensure that the jobs are coming to the UK and that we have the skills deployed to deliver.
Because your remit is so large, and again, it's also intrinsically tied to, the UK citizens, what do you think your hardest part of your job is?
I think the hardest part of my job is to help people understand how important the Crown Estate is to the country. It is incredibly important. It serves national interests both for today. We've delivered £3 billion of returns to Treasury over the last 10 years. We're going to be doing more moving forward. But even more importantly, making sure that we're tackling some of these national challenges and doing it in a way that we just get more impactful and better at doing it as we go.
I mean, are you like a sovereign wealth fund, but with physical assets only in the UK? Is that how, we're trying to help a lot of our viewers understand? How do you see yourself?
I think we're like a sovereign wealth fund or sovereign wealth funds, so insofar as sovereign wealth funds create value for the countries they represent. Right. But I think it's important to just reinforce that we are unique. We sit between the private and public sector under this parliamentary remit to serve the country. So I think, in creating value for the country, yes, but that's probably where the similarities end.
I mean, it's also the coronation 2 days, so I can't not ask you about that. Does it change? I mean, do you have special celebrations in the Crown Estate, or is it just something that's, left to the organisers and the royals?
Well, we think obviously the celebrations over the weekends are great for the country, but our people every day get out of bed and come work for the Crown Estate to create value for the country. Okay.
Dan, thank you so much. Great pleasure to speak to you. Dan Labbat there, Chief Executive of the Crown Estate. And we're also getting some breaking news, PMI out of the UK. This is for April, its services. So it is a little bit backward looking, but still interesting. That PMI coming in a touch better than expected. 55.9, preliminary figure was 54.9. A reminder, anything above 50 is an expansion territory. Coming up, the King's coronation holiday could produce the latest drag to the UK economy, so we'll discuss that next as well. This is Bloomberg. So what are the economic implications for the UK of King Charles's coronation? This Monday's extra bank holiday could prove a drag on growth. It will be the second time in a year that royal events have weighed on the economy. Now, Ana Andrade from Bloomberg Economics joins us. Anna, so how big, first of all, good morning, how big of a drag will we see from the holiday on the UK economy?
Good morning. So we are actually expecting GDP to contract in May by 0.7% on the month. That's a fall that's similar in magnitude to the ones that we've experienced in the extra bank holidays last year. But I would say that the key thing to note is that, it's just a temporary drag on the economy. All the output that it's not produced in a given month will be regained in the following month. So overall, it's not a permanent hit. And the bigger picture really is that, the economy is doing much better than we thought at the start of the year, even with the extra bank holidays and with the industrial action introducing volatility into GDP data.
So what does that mean for the Bank of England going forward?
Well, I mean, the holiday, they will kind of probably, overlook it just because it's a temporary hit. But I would say the stronger economy overall is something that the BOE will consider next week. Although I would say that it's kind of, the surprises that we saw last month in CPI and wage data, that's really what's going to move the dial on the BOE. They had given as a framework at the start of the year that they said that they were going to be very data dependent, and data on that front has only surprised to the upside, giving very little option for the BOE but to hike next week.
So, and I mean, we're in this really kind of funny way where there's a cost of living crisis. Inflation seems to be higher than other parts of the Eurozone, but also growth is better. Does this come all to a head at some point?
Well, I mean, I would just say that growth is better. It's holding up better for now. Yeah. But if you look a bit further ahead in the second half of the year, there's not a lot of growth happening there because we expect tighter monetary policy to weigh on the economy. And I think, the big risk for the UK outlook right now is that if the Bank of England is forced to take rates higher, as it seems to be, then we can have kind of a monetary policy induced recession.
Yeah, and I guess it all depends on the credit crunch that we could or couldn't see. Are consumers holding up okay for the moment?
Yeah, I would say so. I mean, we saw a lot of credit tightening at the end of last year, and I would say that we'll have to see from. In the UK, at least, it seems that the recent banking turmoil that we've seen, it hasn't had as much impact as it has on the US. So yesterday, the Fed, maybe managed to signal a pause, a future pause, because the credit is doing a lot of the heavy lifting. And here in the UK, we just haven't had that on the back of the banking turmoil yet.
Anna, thank you so much for coming on. And I would urge everyone really to look at a lot of what we do on Bloomberg Economics, some great research, Ana Andrade and her team. Now, coming up, we'll talk about In the City podcast with my co-host, Dave Merritt. Always fun, never dull. He joins me next. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, joining us now, Dave Merritt, my co-host on our weekly podcast in the city. Dave and I have been doing this for about just over 6 months, a little bit, maybe more than 6 months. And Dave, we've had fun because we're trying to unpick the UK economy, but through like fun conversations with leaders in their field.
That's right. It's a bit weird, isn't it, sitting at these podiums rather than with our headsets on and our
in like
mics in the podcast
dark
studio.
little room. Yeah.
That's just over there. But the idea for this was to kind of bring the listener into the room, in our big newsroom here, sitting at the heart of the City of London, Queen Victoria Street, over the road for the Bank of England. The conversation's happening here, but also in the square mile around us, kind of shining a bit of a light on the issues and what it tells you about the British economy, about the markets, and about the world as well.
So what surprised you? I mean, we've had some really good conversations. I know, we spoke to Nick Candy, who really said some terrible things about London, and he's moving to Dubai because he can't stand
Right, because of the crime, he said. I mean, that was an episode that went really viral last week. He said Dubai is having its moment, that London's kind of over. Everyone piled in on social media to say he's completely wrong. And that, for me, has been the surprising thing. It's been so much turmoil, hasn't there, in the British economy ever since, I suppose, since the Brexit vote in 2016. But all the people we get in week after week keep coming back to the fact that London is where these conversations matter the most, that London remains the sort of beating heart of the markets across Europe and for investors all around the world.
I wonder whether, and I don't know whether you have this feeling in some, and also shout out to our great producer, Summer, who puts it all together and makes us fun, which is not always an easy feat. No, I'm kidding.
It's a tough edit, I think.
It is a tough edit, but it's basically trying to understand if it's a crunch point where, the City of London could go either way. They could either win this or give its crown to New York.
Yeah, we wanted to go on the road to Paris, didn't we? Because, Paris is definitely on the up in terms of a financial centre in Europe. But, time and again, you come back to the fact that the scale of the infrastructure in London, that the talent, the numbers of people here, it really does outshine everywhere else. I think Alex Brazier, who we spoke to this week, that's the episode out today, from BlackRock, formerly of the Bank of England, he talks about how we're at this inflection point in the global economy and actually how London is poised to really benefit. We're seeing the return of volatility, interest rates staying higher for longer. That's an opportunity for investors, and he thinks London's really well served to really benefit from that.
Yeah, and one of my favorite episodes was also with the Legal and General Chief Executive, and he told us at the time that he was offered, a big job at Apple, and then decided not to take it, and that kind of changed the course. And he's of course also really quite close to the King.
That's right, Nigel Wilson. I think the mic was off when he told us his King anecdote, wasn't it? I don't think
it was, but I mean, people open up, right? And it's very clear that they're businessmen, chief executives, are quite close to the King because of his sustainability efforts.
That's right, and it's a different sort of regime, right, than before. And obviously with the environmental crusading that King Charles has been a part of, he was very much ahead of his time. And that's something we've explored in the podcast.
Coronation plans?
Oh, well, obviously, get the bunting out, have a go at making the coronation quiche, presumably,
I'm in charge of the G&T bar for this.
Right, the drinks, obviously,
Help everyone. David, thank you so much. My co-host, Dave Merritt, and we have a new episode out today. Subscribe, rate, review the In the City podcast. This is Bloomberg.
Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient.
These stresses in the banking sector are likely still there. They're likely still coming. They're likely still tightening financial conditions as we look ahead.
They're trying very hard to separate financial stability concerns, banking system concerns from monetary policy.
They created part of the stress on the banking system that arose when they had to tighten monetary policy by 5% in a little over a year. So the Federal Reserve has some culpability here.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Another U.S. regional bank is raising concerns about the sector's health. PacWest moves to calm the market after shares plunged 60% after hours. The Fed's latest interest rate hike may be the last one in the cycle. Fed Chair Jerome Powell opened the door for the central bank to pause next month after 10 increases. Today, it's the European Central Bank's turn. It's set to slow the interest rate hikes after its preferred measure of inflation eased. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And yet again, another reminder coming after the Fed this time of the tensions around the regional banking sector, Matt. But interesting to see that, yes, Fed futures stock futures, equity futures in the US are not gaining a great deal, but they're also not falling over substantially as a result of this latest round of nervousness.
Yeah, absolutely. And we didn't fall terribly yesterday. We were down about 0.7% in the cash trade on the S&P 500. And as you say, we're unchanged right now, even with, a 60% drop in PacWest. Renewed concerns about regional bank viability. Take a look at the S&P future. Well, they're exactly unchanged right now. So the 10-year yield, I think, is interesting, coming up a little bit, but from such a low level. 2 days ago, we were looking at 355, and now we're looking at 336.36. So a drop of almost 20 basis points. NYMEX crude also right now doesn't look as interesting as it did last night. We saw a 63 handle on NYMEX crude around 8 p.m. yesterday. So it dropped dramatically and it's recovered a bit since then, but still under $70 a barrel for WTI. And I think we see Brent around $73. Interesting that Bitcoin has rallied so much, up back above $29,000, adding 585 to 29,114. So the drop that we had yesterday, it was also in tech shares, right? The NASDAQ also fell a little bit less than 1%. Yet Bitcoin continues to rise. Take a look at what's going on in Asia. You do have big gains in Asia overnight, certainly in Hong Kong, and maybe that's one of the reasons that Bitcoin was able to gain. It does do better in the Asian session. The broader MSCI Asia Pacific Index up only about 0.5%, but the Hang Seng up 1.25%. The Nikkei closing up just a 1/10%. So the action in Tokyo not so dramatic. You do see a little bit of U.S. dollar weakness against the yen. You can now only buy 134.67 yen for a dollar. Anna?
Let's have a look at what's happening in Europe. So this is the European equity market picture, Matt, and really catching up with the in-session moves on the Fed yesterday and also pricing in some of the European earnings stories that we've been dealing with this morning. Yesterday, of course, European markets closed before we got the Fed statement. So that sell-off on Wall Street post the Fed, we had to factor that in to our markets. And so European markets are a little on the back foot. We've got some big heavyweight ex-dividends affecting the some measurements, of course, of these markets. But that's broadly what we see, a little bit of nervousness in the markets. Brent crude is up by 1.3%. To answer your question about where Brent is right now, Matt, you're right. It has a 73 handle. And to your point, bear in mind, we started the week at $80, above $80 at one point on Monday. So in not many days, we have lost quite a lot on Brent crude, even though we bounced 1.3% this morning. And that's despite this concerns around maybe the US economy, maybe the Chinese economy, despite the fact that some really interesting seaborne data showing on the Bloomberg terminal that more oil is heading to China by sea than has been the case over the past 2 years. So that's really interesting to keep an eye on. Sticking with the energy theme, Shell is up by just over 2%. Better than expected numbers, sticking with the trajectory of their buyback, and that's better than we heard from BP, so that stock is rewarded. BMW also beating analyst estimates, and there's a buyback there in the mix as well. They didn't guide higher, that disappointed some, but still the stock is up by nearly 2%. And just checking in, it is ECB day now, Matt. No time to linger too much on what we heard yesterday. We're onto the ECB, and 110 is where we trade right now, down by 0.2%. We've had some data out on the services side, 56, the handle on the services side for the PMIs across the Eurozone, which is, of course, well into expansion territory.
All right, so watching European automakers and watching especially closely the ECB. We'll continue to cover that. But let's get to the regional banks here in the U.S. A new focal point of investor concern about the health of U.S. regional banks. PacWest shed more than half of its value in after-hours trading after Bloomberg reported the bank is considering strategic options, including a sale. By the way, that sell-off continues this morning in the pre-market. It kicked off just after Fed Chairman Jerome Powell said authorities were closer to containing the turmoil that's claimed 4 lenders so far this year.
There were 3 large banks, really, from the very beginning that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress.
As Powell tries to reassure investors the banking system is sound, Pershing Square's Bill Ackman warns that there are still risks, writing in a tweet, quote, "We are running out of time to fix this problem. We need a system-wide deposit guarantee regime now." Michael Moore, Bloomberg finance editor, joins us now to explain what's happening and what options PacWest might have. Michael?
Yeah, so PacWest had said before they were looking at potential asset sales. We've reported that they're perhaps even considering things bigger than that, a sale of the whole company. They did come out with a statement confirming that they are talking to potential partners, potential investors about a range of options. Also said that their core deposits are up since the end of March. So trying to calm markets down a little bit. You know, one thing to note that PacWest is a fifth of the size of First Republic or SVB, so much smaller bank than those ones that ran into trouble. So, you know, as this turmoil continues to not be contained, better go down than up.
Okay, yes, and we keep hearing from the likes of, Jerome Powell telling us and Jamie Dimon telling us that they think the worst may be over, or we're trying to draw in a line in the sand. I mean, do we get a sense, the fact that we can have a 60% drop after hours in one of these regional banks, Michael, and yet the futures picture, yes, it looks sluggish, but it doesn't dominate sentiment.
Right.
Is that a positive?
I think so, and I think it's because you're seeing it go to these smaller banks and not, you know, up the chain to some of the bigger banks, which seem quite in good position right now. If you did have, you know, a sale, like there's a number of banks that could take a bank the size of PacWest on. So I think that's reassuring people. And PacWest did say, you know, they have more than enough liquidity to cover all the uninsured depositors that they have, but they haven't seen significant outflows.
All right, Michael, thanks very much. Bloomberg's Michael Moore covers the banks for us out of London. Now, here in the U.S., the Fed has hiked rates by 25 basis points and hinted it may have been the last move of the tightening cycle. But Chair Jerome Powell stopped short of declaring victory in the battle against inflation, quite the opposite. Former Atlanta Fed President Dennis Lockhart spoke with Bloomberg after the decision.
The focus is on inflation. They're trying very hard to separate financial stability concerns, banking system concerns from monetary policy. We'll see if conditions force them to begin to combine financial stability concerns with monetary policy decisions. As of today, they did not do that, and they don't appear to believe they have to do that.
Bloomberg's Valerie Teitel joins us now for more. So, Valerie, were there any surprises, any curveballs from Powell?
He kept it fairly boring. Even in the Q&A, there really wasn't a lot of market price action around what he said. He did what the market expected to do, and he signaled for a pause, saying we no longer anticipating further rate increases. But he went on to talk about when he was asked about whether they've reached a sufficiently restrictive level. He said we need a few months of data before he can declare that. He's clearly trying to communicate that even if they do pause in June, another hot inflation print in a month's or 2 months' time could cause them to hike again. And that asymmetry in the front-end pricing is what he wanted to achieve. I think he got away with it. He also ended on talking about the banking turmoil, saying that it's resulted in even tighter credit conditions. But he was asked more on this in the Q&A, and he didn't necessarily paint a dire picture. Remember, when it comes to banking conditions, lending conditions especially, the Fed knows a bit more than the market does. So the fact that he didn't necessarily paint this dire picture gives the market maybe a bit more confidence that on Monday, when we get the senior loan officer opinion survey, it won't be as bad as feared.
And just as you told us there would be, Valerie, there was a change to the statement in paragraph 3. So I was definitely focused on the right things yesterday. Thanks to your briefing. Let's pivot from that part of the Fed narrative to something else, because lest we forget, there were actually some open roles, open positions at the Fed that Biden needed to fill, and we've got some news on that.
Yeah, we do. Bloomberg was reporting that Biden is likely to pick the Fed's Jefferson for the vice chair seat, and that nomination can come as soon as Friday. He then goes to the Senate to be confirmed, so the process is still not over. I think, though, the most important thing that has come out of this musical chairs at the Fed was a story that the Wall Street Journal put out over the weekend, signaling that the reason why this Uber dove, Lael Brainard, left her vice chair seat was because she felt she couldn't be as vocal in that seat. She couldn't be seen as dissenting versus Powell because we know she's a dove. She was fighting against those further rate increases. So she's gone now to the White House. Maybe that's a signal that the political winds, the political forces on the Fed might be changing soon, as maybe more of the White House will be clamoring out for rate cuts.
All right, Valerie, thanks very much. Bloomberg's Valerie Teitel talking to us about the Fed decision yesterday. Let's turn our attention now to the European Central Bank decision, which comes out in just 3 hours' time. Bloomberg's Maria Tadeo is on the ground in Frankfurt outside the ECB. So, Maria, we are expecting a hike, but is it 25 or 50?
And for once, it's sunny out here. I'm not sure if that's an omen either way, but it's convenient for me nonetheless. Look, Matt, when you look at that decision, yes, it is understood the European Central Bank will hike again. And how can they not when you see headline inflation still moving around the 7%? Remember, their goal is close but below 2%. Now, the question very much in play is at 25, is at 50 basis points. Now, overall, some suggest Deutsche Bank has a note still saying it is a close call because you could look at data and flip it both ways. Nonetheless, the call that carries some of the bigger momentum going into the meeting is at 25 basis points. When you look at core inflation, which again, this is not the target, but we know because the European Central Bank has made it very clear, very explicit. This is the kind of dynamics and data that they pay attention to. Cooled in April. When you look at the lending survey, you did see that credit standards actually tightened too, and you're seeing this turmoil still play out in the banking sector, which, remember, the European Central Bank also said it would monitor in terms of the implications that it would have for European banks and therefore the European economy. So again, there is some suspense, I guess you could say, but obviously we're waiting for Madame Lagarde to make this official. Nothing is official until she speaks.
Okay, so it's that debate around 25 or 50, market leaning towards 25, as you say, Maria. What else are we going to be watching for then in terms of the decision-making and the communication today?
Yeah, and again, the market very much leaning to that 25 basis points, which is important because if you look at how decision making is going on here at the ECB, it is very clear that this is a twofold decision. It's not just a rate move. When they hike softer, there is an implication that they will have to signal an acceleration on the QT. Remember, these are 20 central banks that have to agree on monetary policy. So to get to a consensus, a large majority, you have to give something to both camps. So I would also watch out for the implications for QT. When it comes to the press conference, especially on a day like today, there will be questions about the Fed and the fall through that could have potentially on the European Central Bank. The idea of banking turmoil increasing, maybe also too in the euro area. There's a spillover effect from it. And then again, it'll be interesting to see whether she hints that the direction of travel is not going to change, that this is going to be a central bank very focused on data, very focused on core inflation, the transmission, and also take it now on a meeting-to-meeting basis, which then takes us to June.
All right, Maria, thanks very much. Bloomberg's Maria Tadeo outside the ECB in Frankfurt. Stay with Bloomberg for full coverage of the ECB decision. It's due out at 8:15, and then, of course, Christine Lagarde, her news conference follows that. Now, let's get a look at some of the stocks that are moving in the pre-market this morning, other than the regional banks. SolarEdge Technologies is one. This company gaining after Q1 profit and revenue topped estimates. The outlook for Q2 was in line with estimates, and investors like that. The shares are up more than 11%. Also, Confluent shares, an application software company, those are up after first quarter results beat estimates, and the company affirmed its forecasts. The shares up about 6% in the pre-market this morning. Qualcomm is a company that's down this morning. The chip maker gave a third quarter forecast weaker than expected. Analysts say the guidance shows that weakness in the smartphone market, which is where Qualcomm is so active with its chips, will persist until September. What happens in September? A new iPhone comes out. Qualcomm shares down 6.6% in the pre-market. And then speaking of iPhone, we're all waiting for Apple. It reports after the bell today, and Wall Street is bracing for the second sales decline in a row as the company battles a spending slump. We're looking for roughly 5% drop in revenue from a year earlier. Analysts believe that all of the company's major product categories, including the iPhone, will suffer sales decreases. That's despite an improvement in the supply chain, so you can get them if you want them, but people just aren't out there buying them at the numbers that analysts would like to see. Anna?
When we come back then, Matt, we will talk about the global economy. We'll be joined by Chris Watling, Longview Economics CEO and Chief Market Strategist, to get the market perspective. We'll also talk to Simon French, Panmure Gordon, Chief Economist. How does he weigh up what we heard from the Fed and look ahead to the ECB? Plus, investors are assessing a slew of earnings for clues on the state of the economy. Earlier today, I spoke with Vincent Clerc, the CEO of the shipping giant Maersk. The company saw profits slump in the first quarter as global trade slowed.
I think after the last couple of years that have been highly unusual with bumper profits across the whole industry and a lot of supply chain disruptions, we were expecting actually that this would normalize. This started already into last year and continued into this quarter. So as we see this normalization, we're going to see also a normalization of prices and a normalization of revenues as a consequence.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York with Anna Edwards in London, and we're there. I have a chart here that shows what the market is pricing as far as the Fed's terminal rate, the highest level it'll get to in this cycle, and that's the white line. In yellow, you can see the Fed's consistent rate hikes. That's the federal funds target rate. The two have finally met. And the question is, do they stop now? Joining us is Bloomberg's markets reporter, Justina Lee. I think it's consensus that this is it, right? Justina, we hold. Obviously, they're data dependent, as always. But the next move will more likely be a cut than a hike.
Yeah, it's pretty obvious that markets had a very dovish takeaway from the Fed meeting yesterday, even though by some accounts, nothing really changed. And I think that's because markets have already shifted the focus to the regional banking crisis. And what they're expecting is, tighter lending conditions, as, Fed Chair Jay Powell flagged himself. And that should help take care of inflation.
Okay, that's really interesting. The role that banks play in this is interesting, isn't it, Justina? I mean, we got some clues, didn't we, as you say, from Jerome Powell about that lending data and what that's going to look like. We thought we'd have to wait till next week, but it seemed as if he gave us a few clues around that. It is something that the Fed is watching, and that would bring their sort of financial stability concerns into the same room, perhaps, as their monetary policy concerns, if we're seeing the tightening in financial conditions because banks are pulling back.
Right, exactly. I mean, the backdrop to the Fed meeting yesterday is that we've seen this really dramatic plunge in banking stocks this week. And it's been pretty surprising given that we already had a solution to First Republic Bank over the weekend, and Jamie Dimon was out saying that the banking system is fine. But clearly that, markets are not consoled at all. And I think what investors have shifted their focus on is the fact that if banks are going to tighten lending conditions, that does make a recession ever more likely. And so a rate cut is still on the table, even though I would say Jay Powell kind of was careful not to encourage that narrative yesterday.
Yeah, he was not encouraging it, but it didn't stop the markets pricing it in, did it? Justina, thank you very much. Bloomberg's Justina Lee with the latest on post-Fed market reaction. And for more market analysis, check out MLIV Go on the Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In Atlanta, police have arrested the suspect in a fatal shooting at a medical building after a manhunt that lasted several hours. They say he stole a vehicle after the attack and then later fled on foot. One person was killed and 4 others wounded. The suspect's sister says her brother was not mentally stable. In China, the economic recovery is showing more signs of imbalance. A new report points to a drop in manufacturing activity for the first time since January. Meanwhile, a surge in travel over the 5-day Labor Day holiday fueled consumer spending. And Bloomberg has learned that the European Union is discussing a new sanctions mechanism. It would target third countries that it believes aren't doing enough to prevent Russia from evading sanctions. The process would focus on those that can't explain spikes in trades of key products or technologies. And it's the biggest IPO in the U.S. since 2021. Johnson & Johnson's consumer health business, Kenvue, raised $3.8 billion in an upsized offering that values the company at more than $41 billion. Kenvue's products include household names such as Tylenol, Listerine, and Neutrogena. Coming up, Chris Watling, Longview Economics CEO. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Another U.S. regional bank is raising concerns about the sector's health. PacWest moves to calm the market after shares plunged 60% after hours. The Fed's latest interest rate hike may be the last one in this cycle. Fed Chair Jerome Powell opened the door for the central bank to pause next month after 10 increases. Today is the European Central Bank's turn. It's set to slow the interest rate hikes after its preferred measure of inflation eased. I'm Anna Edwards in London with Matt Miller over in New York. And Matt, we're dealing with everything today. We've got earnings stories. We've got regional bank tension over in the United States. We've got the aftermath of the Fed, and we work our way towards the ECB.
Yeah, a lot going on today, but it's not moving markets that much at all, at least in terms of the benchmark index futures right now. S&P E-minis are basically unchanged. Take a look, even after the drop that we saw yesterday, about 0.7% in the cash trade. S&P futures not doing a lot. We also saw a drop in yields yesterday, pretty substantial drop, but we don't see much of a bounce back. 336.93 is your level on the 10-year Treasury, and that's up less than 3.5 basis points. We don't see a lot of movement in today's session for crude either, although a big bounce back from the lows that we saw yesterday. At the end of the session, NYMEX WTI crude dropped down to a 63 handle. We've now bounced back to a 69.18, so still under $70 a barrel. But it was a pretty dramatic move yesterday, and it's clear that OPEC, their surprise cut, hasn't done much to uphold the price of crude. Bitcoin has seen a dramatic move. Now, this may be due to the rise we saw in Asian markets. Some Asian markets did really well overnight, including the Hang Seng Index, which was up about 1.7%. As a result, Bitcoin is gaining another $544 today, over 29,000 at 29,073. So just in terms of the regional banks that we're watching so closely, they cratered after the Fed decision yesterday, and after the press conference a few hours later, we saw PacWest down 60% in news that it would seek other options, including the possibility of a sale or raising capital, maybe a breakup. PacWest shares are now down only 37% from the close. But as I said, they were down at 60% at one point in the after-hours trade. Western Alliance is down 17% in the pre-market this morning. MCB is one Metropolitan Bank holding company that's been down with these others pretty substantially and remains with the losing pack, off 15% in the pre-market. And New Jersey-based Valley National Bancorp down about 6% in the pre-market this morning. There are a lot of other movers really in the tech space on earnings. Solar Edge Technologies, which makes equipment that helps you sort of squeeze more energy out of your existing solar technology, is up 11% after it gained in profit and revenue in the first quarter. It gave an outlook for the second quarter that was in line with estimates, and analysts, or investors, I should say, liked that enough to bid it up 11%. Confluent is also up about 6% this morning after that company beat first quarter sales and profits. It also affirmed its forecast. So just leaving its forecast the same was enough for Confluent as well as SolarEdge. Qualcomm, on the other hand, fell after the chip maker gave a third quarter forecast that was weaker than expected. Analysts say the guidance shows weakness in the smartphone market will persist until September. As a result, Qualcomm down almost 7% in the pre-market. And we're watching Apple, speaking of the smartphone market, down 1.3%. We're expecting Apple earnings after the bell, and we're bracing for another sales decline in another iPhone sales decline. The company battling a spending slump and looking at a drop of about 5% year on year. In fact, all of the major product categories are expected to fall. So not just iPhones, but Macs as well as Apple Watches, etc. So watch this space. After 4 o'clock, we'll get Apple's earnings. Anna?
OK, we'll certainly focus on that. Apple, no doubt, one of the big corporate stories of the day. Back here in Europe, then, we've got European equity markets actually worsening their losses a little bit, down by 0.7% right now, catching up with some of that post-Fed move on Wall Street yesterday because the Fed news came, the Fed conversation, pricing in of recession risks a little more maybe in markets. All of that happened after European markets had closed. And so as a result, maybe a little bit of catch-up to play there. Brent crude is up by 1.2%. Matt was talking about WTI. Well, Brent now with a $73 handle. And remember, at the start of this week, we were trading around $80 on Brent. So concerns again around recession in the US and around slowdown in China. Shell, sticking with the energy theme, that stock up by 1.8% this morning. The company beat estimates with its earnings for the first quarter. They're dealing, of course, with lower gas and oil prices compared to this time last year, but they managed to beat estimates, and so that went down well with investors, as did the fact that they stuck to their buyback plans, and that's not what we heard from BP. So as a result, Shell is rewarded. Euro dollar in focus today because it's ECB day, so just checking in there, we are at 110.49, down 0.1% for the euro as we head towards the ECB then, Matt.
All right, we'll continue to watch ECB, or expect the ECB to come out in less than 3 hours. Joining us now is Chris Watling, Longview Economics CEO and Chief Market Strategist, to talk to us about, well, first, I'd love your reaction to the Fed, Chris. Was that the last rate hike, and do we get a cut this year?
Yes and yes. I mean, I think what you saw with the regional banks' performance yesterday kind of says it all. Another rate hike and the idea that they're going to try and keep rates at high levels throughout the rest of this year is really bad news for a lot of these banks. And as you just talked about, a lot of the regional banks suffered significantly in trading after that announcement, after the Fed, and in after hours. So, you know, I think this banking crisis has got more legs to it, and therefore will be pretty soon to cut rates, would be my opinion. So the idea that we're going to stick with a hawkish pause, I think, as it's being characterised, is, I think, probably the triumph of hope over what will be reality.
OK, good morning to you, Chris. I mean, those who see things differently would argue maybe that, you know, inflation is going to be difficult to get down. In particular, this last bit of inflation will be difficult to bring down, and that might get the Fed pausing for a long time, or possibly even thinking about hiking again, as we've seen some central banks have had to rethink their pause, of course. And they might also suggest that maybe this regional bank story goes back under the radar in the way that regional bank failures have been in years past. You don't see it that way, though.
Well, you never know. I mean, you can never say never. But I'd be extremely surprised if that happened. I mean, that's a whole lot of very good news coming all at once, if you like. No, I mean, just look at what money supply is doing, and people have been talking about this recently. M2 money supply is contracting quite fast now in the States. This is really troubling. And as I keep telling people, this hasn't happened any time any of us have been alive. You know, you've got to go back to the 1930s and before. And, of course, the reason it's contracting is because of what's happening in the banking system. You know, because of the banking deposit flight. Most of M2 is bank deposits, you know, sort of 80% of it. So they contract together and they both reflect tight money. So that's telling us, I think, that actually there's a growing risk of deflation. I wouldn't say that's your central case now, but it's emerging onto the sort of radar, and it's something markets are starting to think about. And this is a really critical issue. So will inflation stick around? No, I don't think it will. I think money supply is telling us it's going to go pretty fast. The recession is coming, and the bank problems haven't gone away. So I think they'll be cutting.
OK, you think they'll be cutting. And how do we play stocks with that trajectory in mind, then?
Yeah, I mean, if we're right about the recession, you don't want to be in stocks. I mean, the market's fascinating at the moment. If it's held up. The S&P's held up nicely for 6 weeks. It's been really dull, actually. It's just been 100-point trading range.
Hey, that was okay after March.
That was okay after March, maybe. I don't know. But you want a bit of volatility. But anyway, under the surface, things aren't so good. You know, oil, you mentioned, it's actually down 11% in 3 days. Maybe it's bounced a bit today, but two-year bond yields are back down at low levels from mid-March. 10-year yields are on resistance, look like they want to go lower. The Russell 2000's almost at multi-month lows. The rest of the market, apart from the mega-cap tech, is telling you a different message from what Apple's telling you. So, you know, it's been a narrow advance this year. That's not a good advance if you're a bull.
You know, I was reading Kevin Muir's piece, the macro tourist piece on how to trade after the last hike, and he points out that over the last, I think, 6 or 7 cycles that he chronicled, you do see a rise in stocks 2, 3 weeks, 4 weeks out. But you're looking a little bit longer, right? What are you waiting for to kick off this recession? Or what are you waiting for to go in and buy stocks? Where will we see the dip?
Well, I would say that was an interesting piece. I think I saw the same one. The last 6 examples of when the Fed peaked, most of them you buy the market. You know, if it's a mini-cycle, mid-cycle slowdown, buy the market. If it's a recession, it's a completely different ballgame. And the problem with taking the last 6 hiking examples is only one of them includes a recession. If you look at every recession, when the Fed stops hiking, you sell the pants off stocks. You don't buy them. They're going to go down, and they're going to go down meaningfully. So, you know, I think a recession is coming. I don't want to buy these equity markets until I feel we're near the end of that recession and the Fed's cut a lot. Not just begun, not just paused, but actually done most of their rate hikes.
Is the ECB in
I think you've got to be careful.
Is the ECB in a different place, Chris? I mean, do you expect them to have to keep hiking to tame inflation? Or are we expecting the same kind of earnings recession out of Europe as we are expecting in the U.S.?
Well, as long as I've been doing this job, whenever the US has a small recession or a large one, the Europeans have one that's worse. And I don't think this time's going to be any different. So I don't think they're in a different place. And famously, they always seem to hike into recessions. So I think they'll be stopping sometime soon as well.
OK, Chris, thank you so much. Thanks for joining us. Chris Watling of Longview Economics with his perspective on the global economy and the markets. Next up, we'll get the perspective of Simon French. Panmure Gordon's chief economist joins us shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, the European Central Bank is poised to slow the pace of interest rate increases today. That's after its preferred measure of inflation eased for the first time in 10 months. Officials at the central bank are expected to raise the deposit rate by 1/4 point to 3.25%. Joining us now is Simon French, Panmure Gordon, chief economist. Simon, really good to speak to you. And we'll start with the ECB, but then we'll probably get your thoughts on the Fed as well. So you're in Camp 25 today, as opposed to Camp 50. There are some people in Camp 50. Yeah. Why the 25? And I suppose more importantly, how long can the ECB keep hiking now if you think the Fed has paused?
Sure. So herd behaviour. So central banks tend to move in a pack. And the fact that the Fed went with 25 basis points and I think quite importantly talked about the lags, the interpretation of the lags. I think that's very relevant to the ECB, who are obviously the last of the major central banks that have done a persistent hiking cycle to get going. And therefore, they're least of the way through the lags. So to being able to interpret what the overall impact is on financial conditions, we have less information in the Eurozone than anywhere else, and therefore that heightened uncertainty on what the transmission is, I think, is the reason why I'm in the 25 camp rather than the 50 camp.
And on the subject of how long the ECB keeps hiking for, Chris Watling of Longview and a number of other guests this week citing that old adage that when the US sneezes, the rest of the world catches a cold. Yep. Is the pause going to be contagious?
Right. Some of the pricing is wrong on likelihood markets, because if you look at European and include the Bank of England and the ECB in this, they're looking at about markets expecting another 60 to 70 basis points of hikes into the year end. The market is seeing 80 to 90 basis points of cuts from the Federal Reserve. I can't, in my memory, Chris was talking before the break about his living memory of convergent monetary cycles. I can't imagine that those cycles will be allowed to play out in that way. But, and where I perhaps differ with Chris's interpretation, is I'm not sure that the cycle necessarily is going to play out as the sort of following the US in terms of very weak consumer-led demand leading to a hiking cycle and risk of lending translating itself to Europe. I think more likely is those two likelihoods will converge closer in the middle with more of a plateauing, lower than the market expects in Europe, but rather less cutting than we're seeing seeing priced in the United States.
Simon, I continue to be surprised by how many people expect the Fed to cut rates this year. I mean, they've worked so hard to get up to 525 and to tighten monetary conditions in order to bring inflation back down closer to 2%. And I think they want to get closer than like 4. So what do you think, and what would make the Fed cut rates?
Well, I think you're right to be surprised, and I think you have to start talking about the credibility of what the FOMC and, of course, Chair Powell is saying, because, of course, he's been very persistent in telling the market to expect a persistent plateau. The market thinks it knows better how economic, financial conditions, monetary cycles evolve. Clearly, those of a monetarist bent, and again, we were talking before the break about M2 dynamics in the United States. Maybe that is the leading indicator that the bond market is overweighting versus the central bank. But I think you're right. At the moment, the FOMC couldn't be clearer that it anticipates a persistent pause, but the market is not prepared to listen and thinks ultimately it knows better than the FOMC.
So, but what would cause the Fed to cut? I mean, is it that inflation comes down to 2? Will they cut then? If we get, an extra 1% of unemployment to 4.5%, would they cut then? I just don't know what forces them to do that other than, some horrible economic tragedy in which you don't want to own risk assets anyway.
Exactly. I think it's more the latter. I think even if you saw headline, either PCE or CPI trend to 2, I think the memory of this period and the degree to which excess demand began to fuel uncomfortable core inflation in the US economy means that that would not be the trigger to start a cutting cycle. I think it is if you see widespread evidence of demand destruction, and that requires the type of issues we've seen in the regional banking sector start to translate themselves into a broad-based tightening of financial conditions. There are pockets of tightness in financial conditions, but a broad-based one at this stage, the type that would change the Fed's response function, I don't see that in the data as we sit here today.
Yes, and thinking of the data that we don't know yet but will know soon, Simon, we've got jobs data tomorrow. This is Friday, isn't it? Yeah, tomorrow. Yes. Inflation data next week. I mean, both of those data points, I suppose, have the potential to shake markets if markets have become increasingly convinced of a pause and then cuts later on this year.
Yeah, it might not have felt like it, but it was a rather easier interpretation of the central bank response function last year because they had quite explicit forward guidance, or certainly got to there by the start of Q2 actually last year. Now in data dependency, yes, each print has an added level of resonance. And actually perhaps the surprising part thus far has been the relative stability of those key financial metrics in equity markets, bond markets, to the data prints we've had thus far. I do think that changes as we go through Q2 because of that spread in outcomes between the major economies, particularly Europe and the United States.
Yep. OK, Simon, thank you very much. Simon French of Panmure Gordon joining us with his view on the global economy. Stay with Bloomberg for full coverage of the ECB's rate decision. That's due at 8:15 New York time, 1:15 p.m. here in London, followed by Francine Lacqua's news conference. She'll be in Frankfurt, of course, but giving you the times in London time there. Now, more on the markets coming up, more on the earnings stories coming up. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now we'll look at some of the things that are ahead for today. Earnings season continues. We've talked about some of the big names, with other names also featuring Peloton, Kellogg and Moderna among those reporting before the US market open. Over in Europe, it is decision day, of course, for the ECB at 8:15 a.m. That's Eastern time. The central bank reveals its latest rate move, with President Christine Lagarde set to give a press conference half an hour later. At 8:30, we will get an update on the US labour market, with the latest initial jobless claims data setting the stage, of course, for Friday's non-farm payrolls. And after the bell, Coinbase and Apple both report their quarterly results. Apple, a subject that Matt has been focused on.
Yeah, I'm watching closely to see how they do in terms of iPhone sales. It could be a second consecutive quarter of drops. But I'm also watching very closely what happens with the car makers. After we had earnings from GM and Ford, now we're getting earnings from Volkswagen and BMW. For more, let's get over to Bloomberg's Oliver Crook. He's in Berlin. He's been covering the German car makers for us there. Oliver, let's start with VW. You know, by some measures, the largest car maker in the world. What were the takeaways there?
Yeah, so a fairly strong quarter for VW there in the first quarter of the year. So you had sales up 22%. They beat estimates. You also had margins up, beating estimates. And strength really in the United States and in Europe. And again, helped by that huge backlog you have in Europe, 1.8 million cars that they're still working through to get off and onto the streets. But then you look at kind of the downside of this story. And in China, which, as we all know, is Volkswagen and every German automaker's biggest market, sales down 14.5%. And this is also in the quarter where BYD overtook Volkswagen for the first time in terms of unit sales. I spoke to the CFO a little bit earlier about their China strategy.
Would develop in China for China to speed up the development. And last but not least, we introduced the ID.7. It's a great car. So with all these measures we have in place already, we are quite confident that we can play a leading role in China in the future.
And this quarter, the entire board went to China, to the Shanghai Auto Show. They're really very cognizant of this problem. And really, they think the solution is going to be offering more and more cars to that market in China, including the ID.7 there that's behind him that you just saw. And I also asked them about the price war with Tesla. Are they really willing and ready to wage war with price war with Tesla on EVs? They said no, they really need to preserve their margins and to keep EVs kind of at, more like ICEs in terms of the money that they make.
OK, so a focus on China there. The market unmoved, the VW share price not moving much. What about BMW? We got numbers out from there as well. That stock price moving a little more. Tie it all together for us.
Yeah, so overnight you had a buyback announced from BMW as well, 2 billion euros there. And again, when you look at the regions for them, well, before we do that, let's talk about pricing. It's all been about pricing over this last year for the automakers, particularly the high-end ones. Here in Rolls-Royce and the 7 Series doing the heavy lifting this quarter, that created a massive beat for them on the EBIT margin, in at 12.1%. The estimate range was like around 7%. EV sales up 112%. But again, that was down to North America, up 11%. But you look at Europe, sales down 2%, China down 2.6%. So really, it's just a very strong quarter for the automakers, but everyone is very reticent to give a very sort of punchy outlook looking forward. And that's all down to, will this pricing sort of hold up? Will the slowdown bite? And also we had, Ford out today, they're cutting jobs. So if you can't get that margin up on the pricing, you're going to have to look to save costs somewhere.
Yeah, concern around pricing with the Tesla news, and also demand in Europe, certainly in focus. Oliver, thank you very much. Oliver Crook joining us there from Berlin with the latest on the auto sector. That is it for Early Edition. Surveillance is ahead. They will be talking to Ben Laidler of eToro. This is Bloomberg.